Hello and welcome to Talking Point. I'm your host, Niraj Shah. And the case for a chat today, well, after all the regulatory actions that we've seen coming up in the recent past, there was anyways a question around valuation. So therefore, one primary question, are markets due for a correction? I don't think anybody can answer that per se. I think our guest can merely talk about whether the risks are on the upside or the downside, but we'll try and ask our guest about that. Will headwinds continue for financials, considering that there is a fair degree of coordinated action happening between regulators as well? And we've seen some statements around practices by a couple of NBFCs in the last couple of days. And of course, our guest today spoke about multiple emerging themes over the last 2 or 3 years, well ahead of the street. We'll try and ask him if there is emerging themes, or there are emerging themes that is looking at constructively. Our guest is Hiren Ved, Director and CIO, Alchemy Capital. Hiren, so good having you. Thanks for taking the time out.
Thanks, Niraj. Thanks to be back again.
Yep, great to have you back. Hiren, the age-old question, which usually doesn't have an answer, and I wouldn't hold you to it, but just looking at the concoction of events wherein global growth isn't quite firing, China data isn't the best currently, our valuations are not necessarily cheap, even if not dramatically expensive. And there is some regulatory action being taken, or voices being sounded out, even by AMFI, around the valuations at the broader end of the spectrum. Is there reason to be cautious?
So, Niraj, I've been saying this from the beginning of the year that because we've had such a strong run-up in the markets, it's almost become fashionable to be cautious going into early this year, right? And I'm not saying for a moment that one should throw caution to the winds. Obviously, we have to be cautious in terms of where we are investing. You are absolutely right. We are not cheap, but we are not expensive either. And I think we have been saying this for a while, that whether you look at the last 9 months of this fiscal year, the way the broader market earnings have panned out, or if you look at a 4-year picture from COVID till now, it's quite staggering how earnings for the top 500 companies have grown, right? They've almost compounded at 38% a year. So if you take the Nifty 500 companies, the 4-year compounding, if I were to annualize the first 9 months and then look at March 20 to March 24, we've seen a pretty staggering compounding of earnings. So to that extent, the fundamentals of this bull market are very solid. They are based on earnings. Now, obviously, in any bull market, we do see excesses which build up. There can be pockets of exuberance. We are seeing in this market that a lot of the returns, because of the high visibility over the next few years, could be front loaded, right? And therefore, obviously, this market can be susceptible to both price and time-wise correction. So it's quite possible that that may happen. And to me, it looks like that, there is, as you mentioned, a coordinated regulatory action to kind of preempt any bubbles or so-called excesses that might happen in any part of the market, right? So I think these kind of cautions, breaks within bull markets are actually healthy, because then, people tend to dial back. If there is unbridled fear, and if every day and every week the markets keep going up, it's a sure recipe for building up of bubbles. So I think occasional cautions, whether it is external intervention or corrections because of, whatever global macro or whatever, is actually good in a bull market. But I think this bull market is alive and kicking. Yes, we should all be responsible and cautious. But I don't think that it's going to change the basic direction of this market. I think we are very clear. We are in a solid bull market.
And viewers, to be fair, while the markets have rallied, even at this 21,200, 300 levels when we first spoke to Hiren, when the concerns were existing as well, I think I've heard concerns about markets all the way in the last 2,000 points on the Nifty, that are we overvalued, are we stretched, etc. He had mentioned that he's constructive, and conversation can be replayed wherein he was in the studio, and I think it's worked out well. So Hiren, good call there, and I'll look forward to hopefully the market staying steady and creating wealth. Specific pockets, Hiren, and I wonder if the consistent commentary from the regulator around the need for caution in lending practices, in certain actions being taken by NBFCs, whether lending NBFCs or in yesterday's case a non-lending NBFC as well. Is there a message being sent to the lending system at large to be cautious? Could that impact growth rates? Could that impact valuations? Because investors like yourself might be saying that what's the need to go out and buy NBFCs at premium valuations when there is an overhang of regulation?
I think you're absolutely right, Niraj. All the recent actions by the regulator point to the fact that they want to preemptively cool down unbridled, unsecured lending, right? Now, whether it comes by way of soft advice, whether it comes by way of strictures when it comes to adhering to certain operational processes and risk management processes, I think that this will definitely take the focus of the lending institutions away from growth to sort of look at their internal controls and processes, and it may impact growth in the short to medium term. In the long run, it's all good because, strict regulation is painful initially, but it's always beneficial in the long run. But unfortunately, there is a cost to be paid. And the cost for that would be in terms of growth, we don't know. We'll have to, watch the fourth quarter numbers and then look at it. But certainly, I think all the players will be, focused on kind of getting, getting their house in order, re-looking at their systems and processes. And I do believe that this is an environment in which it is quite difficult for the sector to deliver returns in the near to medium term. I use this analogy that the financial services industry may be going through its US FDA moment, right? So if you know what I'm saying, in 2015 and 16, when similar regulatory interventions were done in the pharma industry, first we thought, oh, it's just one-off plant, one-off company, and then one after the other, you had almost every pharma company coming under very severe scrutiny. Obviously, the intensity was different. In some cases, they got an import alert. And now something similar is happening, that the RBI is, actually asking you to stop a certain line of business, right? Obviously, that's going to impact growth. And to some extent in the near term, it could even impact the sentiment for the sector. As I said, longer run, it's all good. But in the short to medium term, I do believe it will have an impact.
I like the correlation, the US FDA moment for the financial services industry. Could banks thrive in such a scenario, though, Hiren? Because they've kind of taken it on the chin for the last, if not taken it on the chin, certainly have stagnated or gotten devalued, at least the larger ones, in the last 6 to 12 odd months. Could it be their moment? People are looking for quality financials which are not impacted, which have got good practices, and which have growth which is reasonable. Could the HDFCs, Kotaks, ICICIs thrive in such a scenario?
Well, I think they also got a rap on their knuckles at some point in
True.
time, right? So I hope that it's not one versus another. But yeah, I mean, I think for funds which to some extent have to be benchmarked to a certain weight in the sector, and they can't go completely underweight or zero weight, right? There will be some rotation away from, let us say, the NBFCs to the bigger banks because there might be a perceived safety there. But, I mean, my big point, Niraj, has been that I think overall, private financials were the leaders of the previous bull market. And that's a space which had done quite well between, let's say, 2010 and up until, COVID. And then obviously because of COVID, there was a disruption. But, most of them had to make heavy provisions, had to raise capital. But broadly speaking, if you look at it, that entire lot has underperformed the market. And my sense is that, their sheer weight in the index kind of has peaked at 37, 38%. And while I'm not making a case by saying that they won't deliver returns, I think they will, quality financials will deliver returns. But if I take a slightly longer term view, my sense is that their relative weight in the index, will keep falling. And some of the other sectors in the index whose weight was highly compressed will actually relatively rise, right? So I think that there will be bouts where these companies will deliver both absolute and relative returns. But if I take a slightly, 5-7 year picture, my sense is that they will broadly underperform the market.
Okay, so viewers, we take a break then because we have to do that, but we talk about this aspect. What are those which will see a rise in their weightages and relative market caps over the course of the decade? That's the very interesting question and conversation coming up with Hiren Ved on the other side. Stay tuned. Back with Talking Point. Now, before we talk about the sectors which will gain, let's talk about something that is sulking. Citi, in its note, has put out today that a minister, the minister is quoted as saying that they are concerned about the fact that the benefits of lower gas prices have not percolated down to the end consumers, and they will not be hesitating in taking any drastic action. As a result of which, Mahanagar Gas has corrected quite significantly. In fact, some of the others too. They've also cut gas prices. Mika, fill us in on the details.
Yes, so all the gas, most of the gas stocks are in the red, and Mahanagar Gas is the top loser in terms of that. It's down about 12.9%. So Citi's note basically, it downgraded Mahanagar Gas to a sell rating. It also cut the target price by 5% to 1,405 rupees. Now, this was back on regulatory risk on the company's margins. Why the worries were prevalent for Citi is because of the latest statements made by an oil minister in an industry event where the minister said that the full benefit of the gas reforms have not been passed to the end consumer, and that the government is willing to take measures, even drastic steps, in order to ensure the full benefit for the consumers. Why does Mahanagar Gas stand to lose the most is mainly because of their premium EBITDA margins that they do enjoy versus its peers. Citi highlighted that the per unit EBITDA margin of Mahanagar currently stands at rupees 13 per standard cubic meter of gas, while that of Indraprastha Gas and Gujarat Gas stand at rupees 8 and rupees 5. So any drastic steps could renew concerns about exclusivity and the margins and impact Mahanagar gas even more. Additionally, lastly, the Petroleum and Natural Gas Regulatory Board in Feb did announce that they will be getting a high expert level committee to look at the CGD framework, and this also raised more concerns in terms of how the impact would be margin-like for the companies.
Mika, thanks for that. Hiren, can I bring you in on this? Market generally doesn't like regulatory action. Is this a sign that the market is giving that we're not pleased by comments from a minister who says that we'll not be hesitating to take drastic steps for achieving our ends?
So, this is a very potent time where the government wants, especially where there is any sector that reaches the end consumer, like a B2C sector. The government would want that if there are any input benefits or other benefits, then those should be passed on to the end consumer. We must understand that usually during election times, the tolerance for inflation or anything that is inflationary is very, very low. And while in general, this government has stayed away from intervening, but I think this is usually a very sensitive time where pre-election, they don't want any flare-up in inflation anywhere. Look at a series of things that they've done, right? So, for example, it's quite possible, and it has happened so many times that you will see that, if there are certain agri-commodities which are likely to see an increase in prices because of either weather issues or production issues, they would ban exports, right? They did it for some variety of rice. Then they came up with an ethanol policy where they said that you can't use sugarcane to make ethanol because they realized that sugar prices could go up. I think if you look at the sum total of the picture, it is very clear that when it comes down to B2C industries and where it impacts the common man, I think the government would want that any benefits that arise, whether because of taxation, whether because of input costs, needs to be finally passed on to the end consumer, right? So all of that is what I look at is part of the same theme that, they want the impact of inflation to be felt lower onto the general populace.
Fair point. Now, Hiren, I drive back to the point that you made in the first part of our conversation, weightages. We're looking at weightages since 2004. If financials as a weightage has to go off, what could possibly come in? What are your thoughts here? Just add it up with a view on energy, because when we looked at what happened in the last 20 years, energy has had this very large weightage, which has dropped quite considerably now. Is that one of the themes as well that come to the fore?
Yeah, you're absolutely right. So if you look at the weightages from 2003 to 2019-20, right, the weight of financials went from 15 to almost 40%, right? And now they are receding. While the weight of so-called cyclicals, and cyclicals, you put 4 or 5 sectors in that, which includes power, energy, capital goods, autos, real estate, infra, cement, right? What you call as industrials or cyclicals or, energy, the weightage of that, all these sectors put together, had fallen from 67% in 2003 to almost 30%. And this had happened when the markets had gone up 7 times, right? So I think the time has come where weightages of these sectors are likely to slowly and steadily move up in the indices. And therefore, I think with the theme that I've talked about with you in the past, the whole manufacturing renaissance, the fact that this time the growth is not led by consumption, but it is led by the capex cycle, initially triggered by government capex post-COVID, which continues till till date. Every year, the central government is spending more and more on infrastructure, coupled with the PLI schemes, coupled with the supply chain diversification that is happening globally, coupled with the demand for power that is rising. To me, it looks like that those neglected sectors, right, which we all shunned during the previous bull market cycle, where it was essentially financials and consumption that did very well, are all going to come back, right? So I think that power, energy, cap goods, auto, real estate, hotels, infra, cement, I mean, all these sectors, to my mind, will see an increase in their weightages over the next couple of years. But you must understand that it's a slow, steady change. It happens in a very stealth manner, and slowly but surely people realize that what they are owning is not really delivering returns, right? Because we all have the biases of the previous cycle. And because in the previous cycle, when Nifty earnings growth was in single digits and these high quality franchises were delivering double digit earnings growth with high ROEs, that's where all the money gravitated towards. And then eventually these sectors became over-owned, which means that their relative weight in all the benchmarks went up, while the relative weight of the benchmarks in all the so-called cyclical or dirty sectors, went down dramatically, right? Real estate, for example, was 7% and went down to almost 0.7. And now from 0.7, it's just gone up to 1.2, right? So many of these sectors are likely to come back. And I think that what most investors and managers are doing is they are grappling with this transition that is happening, right? Suddenly the PSUs and the real estate, actually, if you see from COVID, it's the PSU banks and the real estate have two best performing sectors, and which is where people have the least exposure today, right? So I think this is a trend. As long as this trend persists, there are some early adopters, and then over time, everybody catches on to the trend, by which time the trend has significantly played out, right? So it's always interesting in markets how these things happen. But I think this is what we believe is likely to happen. And that's why, you see that people keep justifying owning private banks and financials endlessly. And they're all great franchises, nothing wrong. Or even the great consumer franchises, right? But on a relative basis, they keep underperforming. And, the under-owned area of the market keeps outperforming.
Got it. Cognitive biases, a great point to discuss at some point of time in a separate conversation with Hiren. But Hiren, this was lovely. Thank you for your time and the insights. Great having you on Talking Point.
Thanks, Niraj. Great to be there.
Thank you. And viewers, thanks for tuning in to this edition.